Ever wondered how to assess a company's financial health? Financial ratios, key tools used to analyze a company's financial performance, provide the answer. By evaluating relationships between different financial variables, these ratios offer insightful perspectives into a company's financial stability, profitability, and growth prospects. Dive into the world of liquidity ratios, starting with the current ratio. This ratio, calculated by dividing current assets by current liabilities, measures a company's ability to cover short-term obligations. When this ratio is above 1, it signals good liquidity. Then there's the quick ratio. Subtract inventory from current assets, divide by current liabilities, and voila, a stricter measure of liquidity that excludes inventory. Again, a ratio above 1 suggests the company can comfortably meet short-term obligations without the need to sell inventory. Next, we have profitability ratios. The gross profit margin, calculated by dividing gross profit by revenue and multiplying by 100, measures the percentage of revenue that exceeds the cost of goods sold. A higher margin indicates better efficiency. The net profit margin, on the other hand, is determined by dividing net income by revenue and multiplying by 100. This ratio indicates the percentage of revenue that remains after all expenses. Higher margins reflect better profitability. Efficiency ratios are another critical piece of the puzzle. The asset turnover ratio, calculated by dividing revenue by average total assets, measures how efficiently a company uses its assets to generate revenue. Higher ratios signify better asset utilization. The inventory turnover ratio, found by dividing the cost of goods sold by average inventory, measures how quickly a company sells its inventory. Higher ratios suggest efficient inventory management. Debt ratios also play a vital role in financial analysis. The debt-to-equity ratio, calculated by dividing total debt by shareholders' equity, indicates the proportion of financing provided by debt compared to equity. Higher ratios hint at higher financial leverage. The interest coverage ratio, calculated by dividing earnings before interest and taxes, EBIT, by interest expense, measures a company's ability to cover interest payments on its debt. Higher ratios suggest a better ability to meet interest obligations. Investment ratios are equally important. The price-to-earnings (PEE) ratio, calculated by dividing the market price per share by earnings per share (EPS), indicates the market's valuation of a company relative to its earnings. A high PE ratio may signal high growth expectations. The dividend yield, found by dividing the dividend per share by the market price per share, measures the return on investment from dividends. Higher yields may indicate attractive returns for investors. Last but not least, market ratios. The market-to-book ratio, calculated by dividing the market price per share by the book value per share, indicates the market's valuation of a company relative to its book value. A ratio above 1 suggests the company is valued higher than its book value. In conclusion, analyzing these financial ratios helps investors, analysts, and management assess a company's financial performance, identify trends, and make informed decisions about investment, lending, or operational strategies. It's like having a financial compass guiding through the complex terrain of financial analysis. So keep these ratios handy. They might just be the key to unlocking your next big decision.